Did you know that the recent tariff announcements led to the S&P 500 experiencing a historic 9.5% surge in a single day? On April 9th, 2025, President Donald Trump announced a 90-day suspension of increased tariffs for numerous countries, aiming to create a window for trade negotiations. This pause affects reciprocal tariffs for 57 trading partners, including the European Union, Japan, and South Korea, reverting their tariff rates to 10%. However, baseline tariffs of 10% for other nations such as Brazil, Australia, and the United Kingdom remain unchanged during this period. In contrast, tariffs on Chinese imports were escalated to 125% in response to China's increase of tariffs on U.S. goods to 84%, intensifying the ongoing trade conflict between the two largest economies. The announcement had immediate and significant effects on global financial markets. The S&P 500 experienced a historic surge, rebounding nearly 10% following the news. European and Asian markets also responded positively, with Japan's Nikkei and European stocks rallying sharply. Despite this optimism, market volatility persists due to the deepening U.S.-China trade war. Treasury markets, traditionally viewed as safe havens, face challenges amid these developments. Concerns over U.S. governance and potential foreign capital flight led to a sell-off in U.S. bonds, prompting investors to seek refuge in German bonds, which rallied strongly. The yield premium between U.S. and German 10-year bonds widened, highlighting the shifting investor sentiment. This policy shift reflects the Trump administration's complex approach to international trade, balancing protectionist measures with strategic pauses to facilitate negotiations. The 90-day suspension offers a critical window for dialogue with key trading partners, while the increased tariffs on Chinese goods underscore the administration's firm stance on addressing trade imbalances with China. As the global economic landscape continues to evolve, stakeholders remain vigilant, anticipating further developments and their potential implications. The recent 90-day suspension of tariffs by President Trump, excluding those on Chinese imports, introduces a complex set of challenges for the global economy. While this pause offers a temporary reprieve, underlying issues persist, particularly concerning the escalating trade tensions between the U.S. and China. The imposition of tariffs has historically led to increased costs for both producers and consumers. Manufacturers face higher expenses for imported components, which often result in elevated prices for end consumers. This dynamic can suppress consumer spending and dampen economic growth. Furthermore, businesses operating within global supply chains encounter disruptions, leading to inefficiencies and potential job losses. The intensified trade conflict with China exacerbates these challenges. Retaliatory measures from Beijing, including increased tariffs on U.S. goods, have further strained bilateral relations. This tit-for-tat approach not only affects the two nations involved, but also reverberates across global markets, introducing volatility and uncertainty. Financial markets have responded with heightened sensitivity to these developments. Fluctuations in stock indices, currency valuations, and bond yields reflect investor apprehension regarding the stability of international trade frameworks. Such volatility can undermine business confidence, leading to reduced investment and hiring. Moreover, the broader implications of sustained tariffs include potential shifts in global trade alliances and supply chain realignments. Countries may seek to diversify their trade partnerships, reducing reliance on any single nation. This realignment, while potentially beneficial in the long term, introduces short-term disruptions and requires significant adjustment from businesses and governments alike. As the 90-day suspension period progresses, stakeholders must navigate these multifaceted challenges, balancing immediate economic concerns with strategic long-term planning. The decisions made during this window will have lasting impacts on the global economic landscape. The 90-day suspension of increased tariffs by President Trump introduces a complex landscape for businesses, consumers, and international relations. While the temporary pause offers a brief respite, many companies remain cautious. The unpredictability of tariff policies has led to delayed investments and strategic planning challenges. For instance, Tesla experienced a significant stock surge following the announcement, yet analysts remain concerned about the ongoing 25% tariffs on automobile imports and parts, which could increase manufacturing costs and affect demand. The suspension may temporarily stabilize prices for imported goods. However, the sustained tariffs, especially the 125% levy on Chinese imports, continue to pose risks of price increases on everyday items. Retailers like Amazon, heavily reliant on Chinese products, face challenges in maintaining competitive pricing, potentially leading to higher costs for consumers. The tariff pause has elicited varied responses globally. The European Union, for example, decided to pause its countermeasures on U.S. imports, signaling a willingness to engage in negotiations. However, the escalation of tariffs on Chinese goods has intensified trade tensions between the U.S. and China, with both nations imposing significant tariffs on each other's products. This intricate interplay of economic factors underscores the uncertainty that businesses and consumers face. As the 90-day period progresses, stakeholders must navigate these challenges, balancing immediate concerns with long-term strategic planning. The 90-day suspension of increased tariffs by President Trump has elicited a spectrum of reactions from economists, market analysts, and business leaders, reflecting the complexity and uncertainty surrounding the decision. Goldman Sachs has adjusted its economic outlook, no longer forecasting an imminent recession due to the tariff pause. However, J.P. Morgan's chief U.S. economist, Michael Farley, remains skeptical, predicting a likely economic contraction later in the year. He attributes this to a cumulative tariff-driven tax increase of over $300 billion since Trump's inauguration. UBS Global Wealth Management has upgraded U.S. equities to attractive, citing the tariff pause as a factor reducing economic risk. They note that the S&P 500 experienced a 9.5% rebound on April 9th, marking the third largest on record. However, they caution that persistent trade tensions, especially with China, continue to pose risks to economic stability. Despite the temporary relief, concerns about long-term economic impacts remain. Economists warn that sustained trade uncertainty could dampen consumer and business confidence, threatening ongoing economic momentum. As the 90-day period progresses, stakeholders must navigate these multifaceted challenges, balancing immediate economic concerns with strategic long-term planning. The decisions made during this window will have lasting impacts on the global economic landscape. President Trump's 90-day suspension of most tariffs has introduced a temporary reprieve in the ongoing trade tensions, offering a window for potential negotiations and economic recalibration. However, the exclusion of China from this pause, coupled with the escalation of tariffs on Chinese imports to 145%, underscores the complexity and volatility of current international trade dynamics. The immediate market reactions to the tariff pause were notably positive, with significant rallies across major indices. Yet, this optimism was short-lived, as subsequent market downturns highlighted the underlying uncertainties and the fragility of investor confidence. The abrupt policy shifts have left businesses and consumers grappling with unpredictability, complicating long-term planning and investment decisions. Internationally, the tariff suspension has prompted varied responses. While some trading partners view it as an opportunity to engage in constructive dialogue, others remain cautious, wary of potential policy reversals. The intensified trade conflict with China, marked by reciprocal tariff hikes, has further strained bilateral relations and introduced additional complexities into global trade networks. As the 90-day period progresses, stakeholders must navigate this intricate landscape, balancing immediate economic concerns with strategic long-term considerations. The decisions and negotiations undertaken during this window will have lasting implications, shaping the future trajectory of international trade and economic stability. What are your thoughts on President Trump's 90-day tariff suspension and the increased tariffs on Chinese imports? Do you believe this strategy will stabilize the economy or further complicate international trade relations? Share your insights in the comments below. We're eager to hear your perspective. If you found this analysis informative, consider subscribing to our channel for more in-depth coverage of global economic developments. Don't forget to like this video and share it with others interested in understanding the complexities of international trade. For more content on economic policies and their global impact, check out our other videos.